Hello, and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
So we're focusing today on Pfizer, PFE. And this is a stock that has undergone a brutal, I'd almost say traumatic process of valuation compression as 2025 draws to a close. And look, this isn't just a slight correction. This is a dramatic, years-long unwinding of the pandemic valuation premium, really driven by what everyone is calling the COVID cliff.
Indeed. And it's the sheer scale of the financial pressure that really defines the problem here. I mean, PFE peaked at an all-time closing high of $49.87 back in December 2021. Today, mid-December 2025, the stock is trading deep in a depressed 52-week range of, roughly $20.92 to $27.69.
It's a massive drop.
It's a stunning 42.8% decline over just 3 years. And you look closer at the financials, for the first 9 months of 2025, revenue contracted by 2% year over year to $45 billion. Now, they did manage a modest 3% EPS increase to $2.56, but that was primarily achieved through cost cutting, not actual top-line expansion.
And that contraction, that's what sets the stage for our debate today. This persistent decline has driven Pfizer's valuation all the way down to just 8.7 times forward earnings, which is a stark discount when you consider the broader healthcare sector average sits at, 18.3? So the question is simple. Is this an overcorrection, an artifact of fear, a genuine deep value opportunity for patient investors?
Or is that 8.7 multiple an entirely appropriate, even logical reflection of the immediate risks? Is it signaling a classic value trap? I'm going to argue that the price is right where it should be because the company is facing a multi-year revenue hole that it will struggle mightily to climb out of. So investors get their income, sure, but they face a near-certain cap on capital appreciation.
Okay, I see why you think the downside risk dominates the picture, but I believe that narrative fundamentally misjudges the potential in the pipeline. The market has priced PFE for near-term disaster and is just severely overcorrected. I mean, this 8.7 multiple is just unsustainable. When you factor in the late-stage potential, specifically the acquired oncology portfolio from Seagen, and most critically, the new obesity assets anchored by MET-097i. When you actually model the successful commercialization of these future assets, even conservatively, by say 2027, your discounted cash flow models, your DCF models, they suggest a fair value range somewhere between $29.08 and $35.77 per share. That suggests the current price offers a margin of safety far greater than the risk. And plus, that 6.6% current dividend yield is a strong, secure support. This is a company in a necessary, capital-intensive transition, not a slow, irreversible decline.
That's a compelling argument based on forward-looking DCF, I'll grant you. But that model relies entirely on execution, which, let's be honest, we have not seen yet. We have to focus on the immediacy of the revenue erosion. The stock is currently acting less like a growth equity and more like what we call a bond proxy.
Okay, just for the benefit of our listeners, when you use that term bond proxy in this context, how exactly are you defining the stock's function?
That provides reliable, high income, much like a bond's coupon payment, but offers severely limited capital appreciation. The principal value, the stock price, basically remains flat. And PFE fits this perfectly. Its 6.6% yield is attractive, sure, but its top-line growth durability is it's lacking. And that's because of the very concrete, very immediate revenue hole created by the combined effect of the COVID franchise attrition and the impending patent cliff. We're talking about the loss of exclusivity for major blockbusters like Xgellion's. Bearish models that forecast a fair value closer to maybe $24 suggest the stock is in fact fairly priced for a managed decline scenario. That makes the perceived discount at 8.7 completely illusory.
I'm just not convinced that the risk is being managed into a permanent decline. Management has clearly identified the problem and has thrown massive resources at the solution, which is the aggressive pivot to metabolic disease. It's risky, yes, but it's the only viable path to growth.
I agree, the pivot is necessary, but I come at it from a different perspective. we have to focus on the high-stakes nature and the astronomical cost of this pivot. This wasn't a cheap surgical maneuver. The acquisition of Metsera to secure those GLP-1 assets ultimately cost Pfizer $10 billion. $10 billion. That's more than double their initial $4.9 billion offer. So what does that tell you? It tells me management was under extreme duress. That massive capital outlay was secured only after an acrimonious bidding war with Novo Nordisk, a bidding war where Pfizer reportedly threatened legal action. That intense cost and litigious posture, it underscores not only the scarcity value of these assets, but maybe management's financial desperation to fill that revenue gap. And that creates a multi-year funding hole where Pfizer has to finance these hugely expensive late-stage trials without a corresponding revenue boost.
I acknowledge that the $10 billion cost is significant. And yes, the bidding war was fierce, but I would frame it differently. This was a necessary, bold, and ultimately defining move to secure a viable path into the single most lucrative market in pharmaceutical history. The price tag, while shocking, it validates the potential value of the assets they were targeting. The focus shouldn't be on the cost, but on the crown jewel they secured, MET-097I. Yes, its Phase 2b data shared competitive weight loss around 14.1%. Fine, but its critical differentiating value lies in the potential for once-monthly dosing. If they can prove that differentiation in Phase 3, that asset offers a significant convenience advantage over the weekly market leaders like Wegovy and Zepbound. That level of market segmentation justifies the premium paid. And furthermore, the company is diversifying risk with a portfolio approach, right? They have the complementary Yao Pharma licensing deal, which involved a $150 million upfront payment for other assets. It's not a single point of failure strategy.
But that crucial differentiation, the once-monthly dosing, is merely potential right now. It has not been proven out in the late-stage, high-volume studies the market demands. Until that Phase 3 data reads out successfully, the execution risk remains profoundly elevated. We're asking investors to rely on an assumption that a $10 billion asset will achieve clinical perfection and commercial differentiation 3 to 4 years down the line. That's a huge ask. And that skepticism, I think, is exactly what explains the constrained price action. Let's turn to market mechanics, because much of the perceived undervaluation, that deep value thesis you advocate, is driven by investor sentiment and, frankly, misinformation, which leads to artificial barriers to price growth.
That is the key point. Dispelling the retail myths is absolutely critical to recognizing the true value here. We constantly hear the dark pool fears on retail platforms, this idea that price suppression or manipulation is keeping the stock down. That is patently unfounded. The FINRA data is clear. Pfizer's off-exchange short volume ratio, which hovers around 50.87%, is actually lower than the S&P 500 ETF, which sits at 64.78%, and it's significantly lower than its direct peer, Merck, at 58.38%. The trading structure is entirely normal. The whole dead money narrative and the capitulation like the panic selling we saw after the widely misinterpreted RFK appointment news are creating an artificial discount. It's driven by retail emotionality and misunderstanding, not fundamental weakness. This, to me, represents an ideal entry point for sophisticated long-term buyers.
I agree completely that the dark pool manipulation narrative is a widespread misconception. But the resulting dead money narrative is driven by real opportunity cost. I mean, look at the negative total returns over the last 3 years. That lack of capital appreciation is real, and it's reflected in institutional behavior, which fundamentally constrains the price. Just consider the short interest. The institutional short interest is remarkably low, only 2.45% of the float. Now, that doesn't signal institutions are aggressively betting against the stock. It signals something equally detrimental to price appreciation. They are simply choosing not to buy. There is a palpable lack of demand at these levels. Institutions are looking for growth assets, and they see PFE as a high-yield instrument, which just reinforces that bond proxy status we discussed. The stock is simply being neglected by those with the capital to actually drive multiple expansion.
And that neglect, that lack of institutional demand, is precisely why the next few quarters in the upcoming guidance are so crucial. The market needs a clear line of sight, and it's just not getting it yet.
Okay, but before we get to the guidance, I think we have to confront the convergence of regulatory and political challenges that jeopardize future revenue, and the market might not have fully priced these in yet. Think about the recent FDA-mandated updates to the mRNA vaccine labels regarding myocarditis and pericarditis risks. They explicitly noted the highest incidence in young males 16 through 25. Now, while this risk has been known, the formal label update, that increases headline risk, and it just accelerates the decline of the already weakening COVID franchise revenue stream in the public mind.
That's a fair point on the headline risk, and the formal update is certainly material. However, we should clarify that this was an update to the warnings and precautions section. It was not a black box warning, and it affects all mRNA vaccines, not just Pfizer's. The market has been treating the COVID franchise as dead money for 2 years. How much lower can expectations realistically go?
The perception matters more than the classification. But even beyond the FDA, we have the palpable threat of the incoming administration's most favored nation drug pricing policies. And even with PFEs securing that 3-year tariff exemption as a strategic countermove, the pressure on profit margins for key revenue-generating drugs remains severe. This convergence of regulatory action and political pricing pressure makes revenue stabilization much, much harder than your DCF models might suggest.
I'm not convinced that political and regulatory headwinds are the primary driver right now, just because the stock is already so profoundly depressed, trading at that 8.7 times earnings multiple. If the market truly believed in catastrophic regulatory failure, the multiple would be, what, sub 6? The critical event, the thing that truly dictates the stock's short-term movement, is the upcoming December 16th guidance call. Consensus already expects 2026 to be the trough year for revenues because of the patent cliff and the COVID decline. If management confirms key metrics, specifically sufficient free cash flow to comfortably cover that attractive 6.6% dividend, and provides concrete accelerated timelines for the Phase 3 initiation of MET-097I, this removes the ambiguity.
I agree that the guidance call is vital, but I do worry about what management defines as sufficient free cash flow. They have a lot of expensive clinical trials to fund globally.
But certainty, even if it confirms a tough trough year ahead, it establishes a clear, investable floor for the stock. Ambiguity is what keeps the stock neglected in 8.7. Certainty, a defined bottom, a confirmed dividend, and a clear path to Phase 3 for the obesity asset, that is the only thing that can catalyze multiple expansion beyond this depressed level. Investors hate the unknown far more than they hate known bad news.
That's a powerful incentive for management to frame that guidance precisely. And, before we wrap up the core discussion, we should probably quickly clarify one persistent piece of confusion that pops up among retail investors when looking at historical price action. The belief in a 2020 reverse split is a misconception that often distorts analysis of the long-term chart.
Yes. Absolutely critical point. That data artifact that's listed as a 1054 for 1,000 split was not a reverse split aimed at reducing share count. It was a corporate reorganization related to the Viatris spinoff. Shareholders received Viatris shares that was a transfer of value from the company's assets, but they retained all of their original Pfizer shares. The price was adjusted downward historically, which required a mathematical factor, roughly 1.054 in the historical data, but the shareholder share count did not decrease. It's an accounting necessity, not a capital structure concern.
Vital clarity for accurate analysis. Okay, so to summarize my position, while Pfizer's strategic pivot toward oncology and metabolic disease is necessary and undeniably bold, the immediate and concrete risks, the patent cliffs that are actively eroding revenue right now, the high debt and staggering $10 billion cost funding that pivot, and the multiplying regulatory and political pressures, they are significant enough to justify the current pricing. Until clinical data confirms MET-097I success in late 2026 or 2027, the stock remains vulnerable to sentiment swings and near-term revenue contraction. The discount is reflective of genuine, high-level risk, making this a classic value trap.
And my summary remains centered on the investment thesis of patience and execution. The current discount is profoundly unwarranted for a company with this kind of capital structure, a secure high yield, and a strategic plan to enter the largest growth market in pharma using differentiated high-potential assets. Yes, It absolutely remains a show-me story dependent on that Phase 3 execution and the December guidance call. But at these highly depressed levels, the potential upside, supported by conservative DCF models, clearly outweighs the downside risk inherent in waiting for that confirmation. Understanding these bifurcated investment theses is crucial for navigating PFE's complex transition. The decision ultimately rests on whether an investor prioritizes the stability of the high yield and future pipeline potential or the immediate concrete risks of that widening revenue hole.
It is a fascinating, complex moment for the company. It requires investors to truly commit to their time horizons and their tolerance for execution risk.
Thank you very much for watching us. Let us know in the comments what is your opinion and if you want us to review other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.